Okay, so I see that we have already a good number of participants. So let me start by welcoming everybody to the fourth edition of the CBER webinar series. So before we start, I would like to make a short announcement. Until now, we had one meeting every month, so on the first day of the month, and we're going to increase the frequency of the meeting, going from 1 to 2 meetings per month. So the idea is to have a second meeting on the first day of the month. So the format of this second meeting will be slightly different. Right now, we have one talk per webinar. And instead of having one presentation, we will have 2 or maybe even 3 shorter talks of 20 to 30 minutes. Now, our hope is that this alternative format will enable people to present ongoing research and will foster communication and interaction within our community. So instead of meeting on the first week of October, we will meet again on the 17th of September. So this meeting will be hosted by Will Kang and will focus on cryptocurrency trading and returns. So you can access all the information on this meeting on the website of the CBER forum. We also have a Twitter account. And by the way, I take this opportunity to highlight that we have also a YouTube account. So if you go to YouTube and you type CBER forum, you will get to our channel. And on this channel, you will find the recording of all the previous talks. Okay, so if you want to see a talk that you can go there. So as for today, I have the great pleasure to host Rod Garrat. So thanks a lot for accepting our invitation, Rod. And Rod does not really need any introduction, so I will keep it short. So Rod holds a Maxwell C. and Mary Perlich Chair in Economics at the University of California, Santa Barbara, and previously held a position as Vice President of the Money and Payment Studies Function at the New York Fed. So as you all know, he has published many influential papers, and most notably for us on CBDCs, where he had an impact on how we think about CBDCs. And today he's going to talk about why fixed costs matter for proof-of-work-based cryptocurrency, which is a joint work with Martin van Hort from the Bank of Canada. So Martin is also there, you can see him. And okay, so the format of the webinar itself is 45 minutes. It's a 45-minute talk followed by an interactive discussion with all of you guys. Now you can still interact during the talk with Rod by posting questions on the Q&A or by upvoting questions that were already posted on the Q&A. Okay, so don't hesitate to send us feedback. And we will have a couple of breaks during the talk where Rod will take pauses and answer your questions. Okay, and then at the end, I will allow you to raise your hand, and I will unmute you, and you will be able to ask questions directly to Rod. So basically that's it. So Rod, again, thanks a lot for accepting the invitation, and the screen is yours.
Well, thank you, Julian. Thanks for inviting me. So I'm going to present this paper. It's entitled "Why Fixed Costs Matter for Proof of Work-Based Cryptocurrencies," and this paper is joint with Martin van Hort from the Bank of Canada. And so this paper is motivated by an event that occurred in May of 2018 when a spin-off of Bitcoin called Bitcoin Gold was hacked in a 51% attack. And I'll explain what a 51% attack is in a little bit, but at the time, this seemed quite surprising to me because a few years earlier, I had written a blog when I was at the New York Fed in which I basically argued that 51% attacks on Bitcoin were very unlikely. And the reason I argued they were very unlikely was because that even if someone had the ability to undertake such an attack, and by the way, this has to do roughly with having a large share of the computing power that's used to mine Bitcoin. I argued that even if someone had the ability to do this, they wouldn't have an economic incentive to. And this is simply because Bitcoin miners make a lot of money. And if you were to attack Bitcoin, you could probably, kill it. At the time, we thought that if it was attacked, that it would not survive. So you'd essentially be killing the goose that laid the golden egg. So I was arguing that an attack was very unlikely. So needless to say, when I saw this attack on Bitcoin Gold, which is, as I said, a spin-off of Bitcoin, I found this very surprising. And so let me just go in a little bit into what happened with this attack. So Bitcoin Gold was born as a hard fork of the Bitcoin blockchain in October of 2017. So it has many properties that were similar to Bitcoin, but it was created with this idea that Bitcoin had lost some of its initial features that were desired when Satoshi Nakamoto created it, and that is this idea that every CPU be equally important in the mining process, that the coin itself be mined by a vast distribution of small miners. And this had been somewhat disrupted in the context of Bitcoin because people had developed these very specialized ASICs chips, that stands for application specific integrated circuit, which were almost exclusively used to mine Bitcoin and basically took the mining of Bitcoin out of the hands of the average person. And so Bitcoin Gold was created with a different protocol that was ASIC resistant, with the idea essentially of bringing Bitcoin mining back to the people. So this was the basic idea of Bitcoin Gold. Well, unfortunately, that didn't work out so well. And so basically a year later, there was a series of double spending attacks where $18 million worth of Bitcoin Gold was stolen. It was double spent, and I'll explain exactly what a double spend is, from multiple exchanges. And as a result, there was a loss of confidence in Bitcoin Gold. And as I mentioned, this idea that if an attack occurred, there should, in principle, be this drop in the price. That is, people will lose confidence in the coin and be willing to pay less for it. And so, in fact, if we look at this chart is showing what happened around the time of the attack. So this chart is showing two lines. This is the period zero is the time of the attack, and what you're seeing there is two ways of representing what happened to the exchange rate. So we have the blue line and the gold line. So the blue line, the gold line, sorry, is just in terms of dollars. So that's just showing the dollar drop in the Bitcoin Gold price that followed the attack. But then one might wonder whether or not that the prices of cryptocurrencies had fallen in general around that time. And so we also show the same price drop in terms of Bitcoin. So that's the value of Bitcoin Gold in terms of Bitcoin in the blue line. And so the idea that both prices are dropping is suggesting that there was a relative decrease in the price of Bitcoin Gold. So it might seem a little surprising that the drop isn't more precipitous, that we don't have essentially the price falling off a cliff around the time of the attack. But there's a couple of reasons for that. And one is that these attacks don't become common knowledge immediately. So the minute the attack occurs, not everyone hears about it. The idea that the attack has to get discovered, it has to sort of disseminate throughout the web. And also the agencies, of course, take actions to try to support the price, both in terms of announcing changes in the number of confirmations. They announced that they were going to change the protocol. So there are a variety of factors that make this price drop not happen as quickly as you might expect. But needless to say, the price is now less than 1/6 of what it was at the time of the attack. So the question that we're addressing in this paper is, why was Bitcoin Gold subject to a successful 51% attack while Bitcoin itself has not been? And we're going to demonstrate that understanding the role of fixed cost is crucial to answer this question and others. So now let me just give a very quick tutorial on Bitcoin mining. I realize that most of the people in this audience will be familiar, but it's also useful, well, for those who are not, and also it's useful to understand the components of our story as to why fixed costs matter. So the idea is to just think about the idea of how blockchain works. So cryptocurrencies store transactions in blocks. So a sequence of blocks represents the history of all transactions. And here we see a situation where in the third block shown, Alice paid Bob some Bitcoin. And in the future, new blocks would be added. And so that transaction would get buried a little bit in the blockchain. But now suppose that it occurs to Alice that she'd like to use the coin that she gave to Bob to buy something from someone else, right? She'd like to double spend that coin. So in order to do that, she'd like to rewrite history. So she'd like to go back in time essentially and eliminate that transaction to Bob by introducing a new transaction where she essentially pays herself. And Bitcoin, of course, is clever, and Bitcoin introduced two obstacles that prevent this from happening. And one is that in order to introduce this new block, you have to solve this complicated, or not complicated, but difficult to solve a cryptographic puzzle. It involves a lot of computing power. And the success, the likelihood you can solve it, depends on your share of the computing power relative to the network. That's one thing. But even if you successfully do that, people don't recognize your block. Your block has to be part of the longest chain. So that's the second thing. So you not only have to solve that block, but you have to solve a sequence of blocks following it and create a chain that's longer than the existing chain. And so in order to do that, if you can do that, then you will in fact have been able to double spend. But in order to do that, you need at least 51% of the mining power of the network. This is the classic gambler's ruin problem. Again, the likelihood of solving any block is just a proportion of mining power you have relative to others. So in order to make up a deficit in essentially these binary events, you have to have more than 50% of the mining power. Okay, so essentially what we're going to show is that if you attempt to undertake a double spending attack, then there are going to be two issues that are going to concern you. One is that you're going to have to secretly mine these blocks. Okay, so you're going to be delayed on the revenue you obtain from mining those blocks. But more importantly, when you sell those blocks, we're arguing that there's going to be a drop in price. So you're going to have to sell those blocks, or sorry, I don't mean sell those blocks. I mean the mining reward you obtain from those blocks is going to come at a lower price, a lower value. The exchange rate would be lower than if you had cashed in those blocks during your regular operations. So you're going to have a loss in revenue here, and then you're going to have a loss of revenue going forward if the value of the currency is permanently devalued. So those are the two components of costs that are occurred when you undertake a double spend attack. And then the idea is going to be whether or not the value that you can obtain by double spending is going to be large enough to offset those costs. And we're going to explain how fixed costs matter in determining all that. So before I get into the formal analysis, let me just point out that many papers have studied Bitcoin mining in the past. The Kroll et al. Paper is one of the first, and it specifies a very simple equilibrium model of Bitcoin that identifies what the equilibrium level of Bitcoin mining should be. We use a variation on that model. All these other papers use that model as well. And what's very surprising is that these papers all essentially ignore fixed costs. So that is, they treat the cost of Bitcoin mining as essentially a flow cost, which you can think of as either an electricity cost per period, or you can think of it in the case of the Easley paper, for example, it can be a depreciation of the mining equipment, but they don't factor in the initial fixed cost of purchasing the mining equipment. Some exceptions to that are a paper by Eric Budish, which does an excellent verbal discussion of the idea of fixed costs, but doesn't model it formally. And then a fantastic paper by our host, which models, gives the first real full formal structural framework for understanding mining power in the Bitcoin network. They don't address double spending attacks, but they do estimate what the value of fixed costs are in Bitcoin mining, and they estimate that to be around 2/3 of the total cost. So that's very supportive evidence of what Martin and I are talking about today. So one other bit of evidence on that, which I like to put up, is I attempted to do some Ethereum mining once upon a time. And so I purchased the equipment necessary to do an Ethereum mining rig. And so this is done with graphics cards. And so this is my spreadsheet of what I had to buy. And so basically you can see that the electricity costs were $10 a month. But if I add up the graphics card, I purchased the motherboard, power supply, all the things that I had to buy. This is just for one. This is for one mining rig with six GPUs. it was around $4,000. So this gives you an idea that these fixed costs are far from trivial. Okay, so just a preview of some of the results. In terms of just the structure of Bitcoin mining, we're going to show the following. So first of all, we're going to show that if we think about differences between variable cost, whether or not there are fixed costs, or whether or not you account for fixed costs. In the case where there are only variable costs, miners will make zero profits. If the exchange rate rises, miners enter. If the exchange rate falls, miners exit. But with fixed costs, that doesn't happen. You know, in fixed costs, in the long run, miners make zero equilibrium profits. But for any given fluctuation in the exchange rate, if the fluctuation falls, for example, people don't exit right away. So do miners lose money when the exchange rate drops? No, in the case of variable costs. As I said, they just exit. Yes, in the case of fixed costs. This is because of the third point, which is that in the case of fixed costs, mining power exhibits downward rigidity, which is not true in the case of variable costs. And we're going to show, probably most importantly, or most interestingly, is the idea that this has implications for whether or not miners are likely to be willing to undertake double spending attacks. So the cost becomes higher. The cost of undertaking a double spending attack is higher if there are fixed costs, because essentially you're not able to recoup that investment as well. So I will explain those basic results. Then I'm going to go through an extension to cryptocurrency groups. So I'm going to talk about everything as if there's only one cryptocurrency. That's the simplest way to talk about it. But then I'll go through the case where there are multiple groups. And the highlights will be that if there are multiple cryptocurrencies that use the same mining power or the same protocol, but the exchange rates always perfectly move, then it's as if there's only one. That's a rather trivial result. But more importantly, we're going to show that if you have tiny currencies relative to large currencies, which often exists, so this might be thinking of spin-offs that use the same protocol, and the exchange rate correlation is low, or at least not perfect, then transferability essentially eliminates the protection that fixed costs provide and makes double spending attacks less costly and therefore more likely. And you know, that's essentially what we're arguing happened with Bitcoin Gold. And then I'll provide some empirical results that support these theoretical predictions. Okay, so maybe this is a good time to pause in case there are any questions just in terms of the setup before I get into the theoretical model.
So I don't see any yet, so it means that you have been super clear, I guess.
Yes.
But, I don't know. So for the attendees, go on, raise questions. So I can ask a small question, but maybe. Sure. So when you talk about zero profits, you mean about zero profit at every point in time, but it doesn't mean that they have rents, no? So they may make profit ex post, but in expectation, they make no profit from investing in their computing power, no? Yeah. So what I mean is that if we think of the present value of the earnings stream, okay, when I'm saying zero profits in sort of an economic sense, I'm saying that the present value of the earning stream, and the earning stream is the money coming in minus the electricity cost, say, if that present value equals the fixed cost, that's the zero profit condition that would determine entry. So if that rises above, then it's worth it. Then think of the fixed cost as the investment. Then if the present value of the future earnings of a rig exceed the cost of the rig, then of course you'll get entry. And the key is that there's a rigidity, so that if that present value falls below the fixed cost, then someone who's already mining doesn't exit right away. They keep mining so long as they can essentially cover their variable costs. So this will become clear, I think, because I'm going to specify the formal model. Okay, so just a little bit of notation. So the exchange rate is going to be denoted by S, and so that's a dollar per dollar per cryptocurrency, but say dollar per Bitcoin or dollar per Bitcoin gold. And we extract from all the other determinants of the exchange rate, except for the idea that a successful attack will result in a drop in the exchange rate. And so there are, of course, a large number of papers that try to model Bitcoin, what determines the price of cryptocurrencies, or Bitcoin in particular.
I've contributed to that literature. Many people that might be in the audience have contributed to this literature. Mining benefits per block solved, we're just going to call that B. So that's denominated in the crypto units of the cryptocurrency. So that would be Bitcoins. The per period cost of mining a unit is epsilon. That would be a dollar cost. The fixed cost is F, a dollar cost. And then very important in our analysis is the alternative use value V. So this is the idea that if you purchase a mining rig and you pay F for it, then one of the things that will become important is if the exchange rate drops, can you get rid of that mining rig? Like, can you sell it for some value? And that's V. So in the case of something like an ASIC, a specialized ASIC chip for Bitcoin, it really has no alternative use value. So V would be very close to zero. On the other hand, if you're mining with graphics cards, those are used by gamers. So the value might not be quite as high as what you paid, but you'll get something for it. And then coins that can be mined with, say, a CPU, you can just apply that CPU to anything. So the fixed cost and V might be exactly the same. Excuse me. So mining power is Q. So QI just stands for the installed mining power, and QD is the difficulty level, and that's going to be set so that there's one block mined per period. That's a that'll be determined by the protocol. And then the cost of capital is R, so that's going to be effectively the discount rate. So the arrival of blocks is modeled follows a Poisson process, and the rate of arrival, as from what I just said, is going to be 1 over QD. We'll let N of T, that would be a stochastic variable that denotes the number of blocks mined by a single mining unit that operates for T periods. So TK could be the arrival time of the kth block within NT. And if we use that notation, then we can express the present value of a single mining unit that lasts until period T. So the formula you're seeing there under mining rewards, that's just summing up. So S times B, that's the exchange rate times the number of coins you get from mining. I don't think I explicitly said that, but when you successfully mine a block, the reward you get is you get issued new coins from the protocol. So that's those coins are B. And so you get S times B in dollars. And so then this is just all discounted. And then this is the discounted present value of the mining costs, the electricity costs, E. And if we take the expectation, well, then you expect to get 1 over QD per period for T periods. So this formula on the left just is equal to the formula on the right. So it turns out to be a fairly simple expression. And we're going to, in the talk, I'm going to simplify things a little bit, and I'm going to just assume T is infinite. So if we're going to let QD, so QD will be at the equilibrium mining power, and we'll let T go to infinity. And so our formula for the present value simply becomes what's shown in equation 1. And by the way, in the paper, we have a section where we explain how things change if the mining power is finite. So we do a deal with that explicitly in the paper, but for the purposes of the talk, I'll use a simpler version. So then what it means is that it's going to be profitable to install new mining equipment until this is equal. Equation 1 is set equal to 0. So the present value of the earnings is equal to the investment. And so we can define this equilibrium level of mining power Q star F. And then what happens after a adverse shock to the exchange rate of the cryptocurrency? So we denote that by in terms of a percentage drop. So that's denoted by L. So it's going to be profitable to continue mining so long as the present value of the earnings on the left is still greater than V. Because if the present value of the earnings from your fixed investment, from your equipment, if that falls below V, then you're better off just selling the equipment, liquidating it at V. So that becomes a condition. And this is, by the way, where we're getting this downward rigidity in terms of the equilibrium level of Bitcoin mining. So if Q is initially at Q star, the equilibrium level, then we don't see a drop in mining power unless the exchange rate drops to a point where this threshold is met where you're better off liquidating the mining equipment. So, by the way, if you go back, if you look at this equation here, if you just take out the RF, then this SB over E, this equilibrium condition is the same as equilibrium condition that appeared in the earlier work that only addressed fixed cost. So you see how, or that only addressed variable cost. So you see how, very simply, how adding fixed cost changes the analysis. So we can see this quickly, just illustrate this graphically. And so if we illustrate this, what we see is that I'm showing 3 scenarios here, which differ in terms of what we're imagining the alternative use value V is. So maybe the first one to talk about is the dotted blue line. So if the alternative use value is F, so the equipment can just be used, can be sold for the same value that you bought it for. That's effectively the same as if there were no fixed costs. Then as the exchange rate drops, that should really say percentage drop, not percentage loss. But as the exchange rate drops, then the mining power just drops linearly. It's as if there are no fixed costs. And then the black line is showing an intermediate case where there's some value V that you could liquidate at. So you would not stop mining until you hit V, and then you would start decreasing your mining power for further drops in the exchange rate. And then the green line is showing the extreme case where the value is 0. So that would be something like Bitcoin. That would be the most rigid. And then likewise, that has implications for thinking about what the present value of the mining equipment is, what the present value is of the earnings of a mining rig. So if there are no fixed costs, or if you can liquidate at the fixed costs, then that present value never changes. Otherwise, it drops until it hits V, and then it remains constant at V. Otherwise, it can drop all the way to 0. And the right chart is going to be important for understanding the costs associated with a 51% attack. So I'll now talk a little bit about a test of these hypotheses, because essentially what we've done is we've introduced a model that suggests that if fixed costs matter in cryptocurrency mining, then we should expect downward rigidity. So we should expect not to see a drop in mining power when we see declines in the exchange rate, for all declines in the exchange rate. And so the model we look at is fairly simple. We're looking at the dependent variable is the changes in mining power, and the regressors are, so change in S is the change in the exchange rate, and then the change in S max is a variable that asks whether or not the exchange rate has risen above a previous max. So suppose the previous max was 100. And then the exchange rate from one period to the next fell, say, to 90, then that variable would just be 0. But if it rose above a previous max, if 100 was the previous max and it rose to, say, 110, then that max would be captured. That change would be captured in that variable. So essentially what this means is that if fixed costs don't matter, we should expect the coefficient on beta 1 to be significant. So we should see variations in mining power for any fluctuation in exchange rate. And if fixed costs matter, then beta 2 should be insignificant. We should only see a fluctuation when we're rising above a previous max. And so if we turn to the regression results, so what we did here was we did a regression on a number of coins. So we essentially looked for a set of cryptocurrency coins that met the following criteria. So we wanted large coins because I've already alluded to this idea that if a coin is very large, then it's almost as if you can almost think of it as if it's the only coin. And so we look for the large coins. So we look for coins that had greater than 5 million. We look for 3-year price history and mining data. We looked for no changes or no significant changes that we could recognize in the algorithm over the time period. Although that's very difficult, because even if the algorithm itself doesn't change, the development of things like specialized ASIC chips and so on that can be used to mine that algorithm do change. And so it's very difficult to nail that down perfectly, but we did the best we could. And these coins represent 5 different protocols. So Bitcoin, of course, is SHA-256. Ethereum is Ethash, and these other currencies use other protocols. And so the main results I'll highlight off the bat is that Bitcoin looks very much like we would expect. So Bitcoin has highly specialized mining chips. Therefore, the V is close to 0. So fixed cost should matter. So we should expect the coefficient on beta 1, the change in the log, to be insignificant. It is. And we should expect the change, the coefficient on the change in the peak to be positive and significant. And it is. By the way, the other regressors here have to do with dummies for when there are changes in the block rewards. But anyway, so Bitcoin looks very much like we would expect. What do we think with Ethereum? Well, Ethereum is kind of an intermediate case where it uses graphics cards. So these have some use value. It's not 0, but it's not full either. And so maybe, conveniently, we get something that's sort of intermediate. We get mild significance on both coefficients. And then these other cryptocurrencies, we at least believe that something like Dash, which uses the X11 protocol, which is sort of a combination of multiple protocols, and we believe can be mined fairly effectively with non-ASICs chips, there we should expect it to be more like a case where there are no fixed costs. And so we should expect the beta 1 coefficient to be significant, it is, and the beta 2 coefficient to be insignificant. By the way, what's really important when we talk about this idea of ASICs chips is whether or not the chip is sort of special to that currency. That is, whether or not that particular chip can only be used to mine that currency, or whether or not it can be used across many different currencies. That is, whether or not there's this ability to substitute into it, as I'll explain shortly. Okay, so having in some ways at least provided some supportive evidence of something happened with my screen. Is it the same with you?
So the screen has changed a little bit, yeah. It's fine, huh?
Okay. So
maybe you want to take question now, because I have a couple of them, or later. What do you prefer?
I'm happy to take some questions.
Okay. So I have a question from Fad, who is asking whether miners internalize that the exchange rate may drop such that they will want to exit. If so, could you clarify where that shows up in the equation you showed before? And actually, it's a bit linked to something also. I have a question on that. So what is exactly the timing? So you're assuming that price and difficulty are constant over time. So the dynamics of the model is a bit unclear to me.
Okay, yeah, sure. So we're starting off assuming that there's that the best way to think about it is that we're starting off by assuming that the market is in equilibrium. So there was an exchange rate that was, say, relatively constant. Entry occurred up to the point where the present value of earnings equaled the cost of the equipment, and so that's an equilibrium.
Okay, so
then we assume, and then we assume quite simply that there's a shock to the exchange rate. So suddenly the exchange rate drops, and it drops by L%. So in this equation here, 1 minus L, so if L was 10%, then suddenly the exchange rate is only worth 90% of it used to be. So we just have this, we're just modeling this very simple one-time drop in the exchange rate. So now all of a sudden, from your perspective, your future earnings forever are 10% less than they used to be. And you have to decide, again, in this simplified framework, your mining equipment lasts forever. So you have to decide whether or not you're going to keep mining or whether or not you're going to stop mining and liquidate your equipment. Okay. And that decision pivots on whether or not the earnings have fallen below what you can sell the equipment for. So it's the classic story that when if the price drops, you're operating at essentially a loss. You're not recuperating the value of the equipment. But as long as you're recouping some of the value, that is, as long as the revenue is greater than the variable cost, then you want to continue mining. So that's the story is as simple as that.
Okay. So in your steady state, price are constant. Technology is also stationary. So machines are always the same and so on. Okay.
That's right. That's right. The only difference is that in the actual paper, we allow the equipment to expire. So basically after, so for some number of periods, which you can determine, it's a variable in the model, the equipment breaks down. So you could think about that as a time at which the technology fails, or the time at which new equipment comes in and is superior, and so the technology becomes obsolete.
Okay.
But nothing is yeah, we don't model specific dynamics within that context.
And I have a second question by Andreas. So he asked, so he said, I thought Ethereum was set up precisely so that ASIC mining does not provide any advantage. Is that
yes,
true?
That's the idea. That's right. That's what we're essentially saying. But there's still, that's right. So with Ethereum and other coins like it, you can mine it with graphics cards.
Yeah. But you still
so
find
that's
a coefficient which for no downward rigidity?
well, yes, because the graphics cards cost money.
Yes.
So that's
okay. So it's the intermediate case. Okay.
Exactly. But what's crucial is that even if an Antminer chip for mining Bitcoin costs the exact same as the graphics card for mining Ethereum, the difference is that you can liquidate the graphics card at some reasonable fraction of what you paid for it, right? The V is maybe 1/2 of F. Whereas in the case of Bitcoin, the V is 0. Bitcoin, specialized ASIC chips for mining Bitcoin aren't good for anything else. So that's the key difference.
Okay, thank you.
Okay.
That's
sure. So okay, so let's get on to talking about double spending. And so what does all this mean for double spending? So what I've written here is I've written the cost of a double spend attack. And so this has two components, as I alluded to at the very beginning when I was giving that sort of quick tutorial on Bitcoin mining. So when you want to attack the coin, what you have to do is you have to secretly mine a series of blocks that allows you to start from where your transaction occurred and catch up to the existing length of the blockchain. So during that time, you're secretly mining blocks and you're succeeding, but you're not collecting any rewards because you're not announcing those blocks. You have to keep your attack secret. So when you finally announce the attack and cash in all those blocks and get all those rewards, you're going to get them at, in our model, this reduced price because the exchange rate will have dropped because of the announcement of the attack. And so the rewards you get, instead of SB, you get ISB. So this is a reduction in the rewards you get, the present value of the earnings you get from your mining equipment during the attack. And then also, again, in our very simplified setting, that drop in the exchange rate lasts forever. And so your future present value from now on till the end of time is also lower, okay, by this percentage L. So you lose money while you're engaging in the attack, and you get less money from your mining equipment while you don't lose money, you get less money from your mining equipment while you're engaging in the attack, and you get less money from your equipment from then on. And so the idea is simply that so again, the attack is hurting the currency. It's causing the currency to be worth less. So that's a costly component. And so the question is, can you double spend a number of coins, D? So that's how many coins you double spend. Can the number of coins you double spend, can that value be greater than the reduction in the value of your mining equipment? That's the trade-off. And so that's an equation which we can write more formally. So P is just, if LVT, that's the value of a single mining unit. So, or this is P is the share of the mining unit you control. So we make that 51%. But the idea is that this just gives us an equation that determines how many coins you have to be able to spend, which depends on how costly the attack is. So that depends not only on how big the drop in the exchange rate is, but it also depends on what the liquidation value is of the equipment. So notice that your cost for all time, right? The cost moving forward after the attack occurs, or the reduction in revenues for all time because of the fact that the exchange rate dropped. The extent to which you bear the brunt of this depends on what your liquidation value is. So if your liquidation value V is equal to F, that is, if the minute the exchange rate drops, you just sell your equipment for what you paid for it, then there's no cost here, right? There's no cost moving forward. You cause the value of the currency to fall, but so what? You just get out, right? So that's the sense in which Bitcoin attacks are not very costly if fixed costs don't matter. But if V is large, if V is small, if V is say 0, like in the case of Bitcoin, then you can't liquidate your equipment for any reasonable value. And so every drop in the exchange rate that results from the attack, you feel the brunt of that for all time, or for at least as long as your mining equipment works. And so that's the sense in which Bitcoin attacks become much more costly in a case where the mining equipment you have has a very low alternative use value. And that's typically true for very specialized ASICs chips. And so we have a nice table here which illustrates what this means empirically. And so the way to look at this table is, so we're showing two things, because one of the things that this result speaks to is that a lot of people have written articles talking about whether or not Bitcoin is doomed when the mining rewards cease. So the Bitcoins that you get when you mine a block of Bitcoin, and this is true typically of all this altcoins, these have every so many periods. So you get less Bitcoins for mining after, I think it's 200,000 blocks in the case of Bitcoin. And so what this means is eventually there'll be no rewards for mining that come from the protocol. And the only rewards you'll get will be from transactions fees. And again, papers like Uberman et al. And the David Easley paper, they talk about sort of thinking about what's going to happen in those scenarios. But needless to say, the rewards to mining will be considerably less. And if the rewards to mining are less, then that makes the possibility of double spending, might make the possibility of spending seem like a better idea. And so people are saying that Bitcoin is doomed. And so what we do in this table is we say, so in the top, we consider the case where the Bitcoin, the next halving has occurred. So you're getting 6 Bitcoins per block. And we don't know what the drop in the exchange rate would be. As I showed in the case of Bitcoin Gold, the exchange rate dropped more than 50%. But we consider 15, 30, 60%, just 3 cases. And then we consider 3 cases for the alternative use value. So if the alternative use value is 100, this is the case where it's as if there are no fixed costs. And then if the alternative use value is 0, this might be, say, Bitcoin. And so what this shows is that if you look up here in the top left, if fixed costs don't matter, then you don't lose a lot when you attack. And so therefore you don't need to be able to double spend a whole lot of coins in order to engage in a successful attack. So you need to double spend relatively few coins in this scenario, as opposed to, say, the scenario in the bottom right. So alternative use value is 0. So think of like Bitcoin, and we have a big price drop. So here you would have to spend hundreds of thousands of Bitcoins in order to make a double spend worthwhile. And so, and that's, by the way, that's hard to do. You have to acquire those coins. You have to find someone that will take those coins from you and not impose, high levels of confirmation and so on when you try to redeem them. It's not easy to double spend that many coins. And then when we move to the bottom panel, this is looking like the doomsday scenarios where the rewards have ceased and we're only looking at transaction fees. And so when we look at a situation like here, then this is consistent with, there was a BIS study recently that came out and said that once rewards are 0, it could take months before a Bitcoin payment is final unless a new technology is employed. And what they're saying is that if we're in a scenario like this, where a double spend attack is feasible by spending only a few Bitcoins, then you'd have to offset that by requiring very high confirmation times. But what we're saying is that if you account for fixed costs and the fact that specialized chips like Bitcoin have very low alternative use value, then we're in the bottom row. So we're looking at still very high numbers of Bitcoins that have to be spent, or even higher if we're looking at larger drops in the exchange rate. So our conclusion is that Bitcoin is not doomed. And one of the things that protects it is the fact that it's mined with specialized ASICs chips that are not good for anything else, that have very low alternative use value. Okay, so I guess we could pause again for questions at this point before I talk about extend this to currencies with alternative, where situations where the same mining rig can be used to mine multiple currencies.
Okay, thanks. So if I get it right, you're suggesting that fixed cost improves the security of Bitcoin, and
fixed costs and low alternative use value.
Yes. Okay. So irreversible investment, essentially, no? And
yes.
Fahad, following up on his previous question, is saying that if you were to have an environment where you have uncertainty, miner will internalize the fact that the price may drop, and they may procrastinate before entering the market. It's a traditional real option argument that when you have irreversible investment and uncertainty, you wait before entering, no, the classical real option theory. And so, isn't it possible that this decreases the overall amount of hash power that you have installed at any point in time? So and so lower the security of Bitcoin.
I can take that question, Rod.
Oh, sure.
Yeah. So we don't model this in the paper, but if you just think about it quickly, so basically what's providing the protection here of Bitcoin is the downward rigidity. So basically, if you kind of think about the question, you want to translate it into whether accounting for uncertainty is going to increase or reduce the downward rigidity in mining power. Now, if you think about the case where you have just variable cost, like you don't have this entire argument. So basically, whenever there's a drop in the exchange rate, you will have a proportional decline in mining power or a proportional increase. Now, if you think about like the case where you would have fixed cost, but now you don't just want to make good for the return on your capital, but you also want to account for potential uncertainty that you might have to stop mining because there's downside risk in the exchange rate. Then basically what will happen is that the equilibrium level of mining power will be lower than the amount that we get in our model, which means that the return that you make, as long as the exchange rate stays high, will be higher to start with, which basically will increase the downward rigidity. Like before you get to this exit point where it's no longer worthwhile to mine, you will need a larger decline in the exchange rate because the initial amount of mining power is lower to start with.
So what you're saying, if I get it, is that it's not really the level of the mining power that matters, but its response to shock and whether it's downward rigid.
Right. It is kind of the potential loss. So if the initial amount of, or if the equilibrium level of the mining power is lower because of potential uncertainty, like basically all the miners, they will make higher profits as long as the exchange rate doesn't drop. So their stake becomes higher. So they will want to care more about potential drops in the exchange rate. Okay. But we don't formally model this in our model. I think, Julian, you do a great job in your paper, but you've seen how difficult it is to basically kind of model that entry and exit decision.
I don't look at attack.
No, exactly. But even without
sure.
attacks, it's really hard.
I agree. So actually, talking about attack, Jacob Lesno has a question. He's saying, imagine that the exchange rate drops after a double spend. Now the attacker could benefit by shorting the coin, or couldn't it? Yeah, sure.
Yeah, I guess so. Yeah, I mean, we're not incorporating that type of manipulation.
That's right. But
it could short actually the hardware too, no?
I don't know. I don't know if you could short the hardware, but yeah.
If you could.
But if you think about it, like reasonably, so that is definitely true. So people basically were saying like the person should care about the potential drop in the exchange rate, but you would need to hedge a considerable amount because we're basically you got to hedge like all the future mining rewards. But that's a very fair point.
Okay, so you don't have much time, so maybe Rod, I'll let you finish. Now you have like actually 5 minutes, something. So 10 minutes. Yeah.
Yeah, I could finish in 10 quite comfortably, I think, if that's okay.
Okay, great.
So let's now just consider the situation where the mining rig that you purchased can be used to mine multiple currencies, and I can give I think a very intuitive explanation as to how this changes things. And so let's consider what happens is now is we essentially have two equilibrium conditions. So one thing that's going to have to now be true. So I have this mining rig, and I can point it to cryptocurrency A, or I can point it to cryptocurrency B. And by the way, this is what happens in mining pools. I mean, when you join a mining pool, the mining pool is constantly reallocating the mining power to wherever the value is the greatest. And so we have this equilibrium condition that basically says that the revenues that you're getting from each currency per period have to be the same. And then you also have your new essentially zero profit condition that says that the present value of the total revenues that you're getting minus the costs have to equal the value of the investment. So it's essentially just the new version of the zero profit condition with two currencies. And so what happens when you have a drop? So in the paper we consider drops in either or both cryptocurrencies, but for the presentation, let me just consider the case where the exchange rate of cryptocurrency B drops and the exchange rate of cryptocurrency A does not change. So what happens now is that, so this SB1 minus LB, so this is the drop in cryptocurrency B percentage. So again, if that's 10%, the thing dropped 90%, is now 90% of SB. Well, this thing's smaller, so QB has to drop. But what you do is you're going to substitute. You're going to substitute towards the other currency because you have to keep the revenues the same, the expected revenues the same. So QB drops and QA increases, but QI, the total amount of mining power, doesn't change. Okay, so what we end up getting is we get a substitution of mining power from B to A, economically very intuitive, right? The value of mining B dropped, the value of mining A did not drop, so you substitute towards A. But the present value of our overall earnings drops, okay? Because one of the currencies that we're still mining some of is worth less. So this drops, okay? And so that's gonna drop, and we're gonna keep substituting from B to A until what happens? Well, until the earnings that we're getting from mining fall to V, until it just becomes, just as before, a better deal just to stop mining altogether and liquidate the mining equipment. So we get a new threshold, okay, at which would define how far the currency would have to drop in order for us to want to just pack it in and sell our graphics cards, okay? So if we look at this graphically, what I've shown here in the right panel is just for reference. Remember before, if B was, say, the only cryptocurrency and had some intermediate value V at which you could liquidate it, then if the price of the exchange rate of cryptocurrency B fell, remember you have this downward rigidity, so you would just not change your mining power until you reached V, and then you would start to sell off your mining equipment for further drops. And whereas if we have the alternative, if you have this other cryptocurrency A that you can mine with that same mining power, then you substitute towards A. So you see that instead of, you actually do respond immediately. So the minute the exchange rate of cryptocurrency B drops, you actually do respond because you substitute towards A. So this is, so what you can probably see from this, is that this can start to look you know, a lot like what it looks like in the case where fixed costs don't matter. So having the ability to substitute into another currency brings us closer to the case where fixed costs don't matter. You can see sort of in an extreme case, this green line could look almost perfectly linear. That would be the case, for example, if cryptocurrency V was very large relative to A. Sorry, if cryptocurrency, well, let me summarize the results here. So if the summary of these results are that if the exchange rates of A and B are not perfectly correlated, so what I actually showed you was the case where the correlation was 0, but what I was trying to say a minute ago is that it generalizes. Then the mining power of B responds immediately to changes in the exchange rate. And if B is very small relative to A, then the response looks similar to the case of no fixed costs. Whereas if B is very large relative to A, then the response is going to look similar to the case of fixed costs. And then one additional result, as I mentioned earlier, is that if the exchange rates are perfectly correlated, then when the exchange rate drops in B, if it also drops by the exact same amount in A, then substitution doesn't occur. You just simply keep mining until that drop reaches the threshold V, in which case you exit. So we end up with these kind of interesting theoretical predictions for the case where we are having an alternative currency that we can mine, and we can test these predictions empirically, just as we did before. So we do 2 regressions here. So one of these regressions is just checking for the fact that there's a difference between big versus small currencies. So the first column of results that you're seeing is a situation where we used 10 Bitcoins. So we used the 5 large Bitcoins I talked before. We added in their 5 smaller cousins. So the smaller versions of those coins that use the same protocol. And what we see, so what should we expect with big versus small? Well, if the currency is big, then we should expect that fixed costs wouldn't matter, which means that if fixed costs shouldn't matter, then we should expect the coefficient on beta 1 to be insignificant. Well, it's sort of significant, but it's not significant at a high level. And we should expect the coefficient on beta 2, the change in the peak, to be significant and positive, which it is. So that's relatively consistent. Whereas if we're looking at the idea of a small currency, if it's a small currency, then it's as if it's as if fixed costs don't matter. And so what we would, because you're just going to substitute in, all that mining power just flows into the big currency with very little effect on that big currency. And so we would expect the adjusted sign on beta 1. So the dummy variable here is 1 if it's small. So in this case, what happens if we add up this coefficient and this coefficient, so what 0.169 and 0.147, we expect that to be significantly positive, which it is. Whereas we expect the sign on beta 2, when you add in the fact that it's a small coin, we expect that to be insignificant. Okay, and so if we subtract 0.225 from 0.537, turns out it's still significant, but it is considerably smaller. So these results are broadly consistent with what the theory predicts. Then I'll just quickly say something about the dynamic correlation, because then I am finished. So what we did with dynamic correlation is here we're only considering small coins. And so the idea is that if you have a small coin and the exchange rate is weakly correlated with the other coins, then it's as if fixed costs don't matter. We should just see we should see that it looks very much as if it's a coin for which you can fully liquidate your mining power, because you can move into the large coin with very little effect. And so what we would expect there is we would expect to see a significant coefficient on beta 1, which we do. the change in just the rate. So the mining power just fluctuates with the change in the exchange rate. And we would expect to see an insignificant coefficient on beta 2, the change in the peak, which we do. So that's wholly consistent with what the theory predicts. And then on the other hand, if the correlation is high, so for example, if we just look at the dummy value, the variable, so if we, setting that equal to 1, if we add in the coefficient to each coefficient, the component that comes from the interacted term, then what we get is that we expect that the coefficient, the adjusted coefficient on beta 1 would be insignificant. Well, that's 0.756 minus 0.816, so that is essentially 0. So that's what we expect. And then finally, we would expect the coefficient on the adjusted coefficient on peak level to be significant. And so that's where we'd be adding negative 0.39 to this 0.636. And so what we do when we do that is we do get a positive number. It's still insignificant, so that's not perfect. But the magnitude is very similar to the value of the coefficient we got on the peak level coefficient beta 2 in the regression for a single cryptocurrency. So broadly speaking, these empirical results are supportive of the theory that accounts for transferable mining power. So I'll just summarize, and then I can come back to that if anybody has any particular questions. But I think one of the key takeaways from this is that if a cryptocurrency is mined with a equipment that can be used across multiple currencies, then that negates the importance of fixed costs, and that makes double spending attacks more likely, or makes the currency more vulnerable to double spending attacks. Okay, so I can conclude. So what have we shown? I guess first and foremost, we've shown that accounting for fixed costs and alternative use value is crucial to understanding mining behavior and the profitability and therefore likelihood of double spending attacks. We've shown that ASIC mining reduces the profitability of double spending attacks. And again, what I mean by that is, the development of specialized chips that are good for mining that equipment, that particular coin, and not much else. They reduce the profitability and therefore weaken doomsday predictions for things like Bitcoin. And then finally, that if you have a cryptocurrency that can be used across multiple currencies, as I just said, then that's also very important to understand. Okay, because that can negate the importance of fixed costs, or the protections in some sense that are provided by fixed costs. And one other point that is implicit in all this, which I like to make, is that one of the things that this points out is that the properties of the mining hardware, but also the historical exchange rate path, are important for thinking about when a cryptocurrency is safe. So whether or not mining power fluctuations are going to occur, or what the losses are going to be that are associated with attacks, have something to do with how far we are from a previous peak. And so that's something that I don't think you hear mentioned very often. So both the type of mining equipment, but also the historical exchange rate path are important to thinking about how secure a coin is at any point in time. And so that's where I can conclude, and I'm happy to answer any additional questions.
Okay, thank you. So I have a question from Catherine Tin. She's asking whether, even when the equipment is specialized, like for Bitcoin, will it be possible to sell that equipment to another miner?
Well, yeah. Well, all the miners are in the same boat, right? So so they wouldn't pay you more for it than it's worth to you.
Except if there's some heterogeneity in technology, some are better.
No, fair enough. And we're certainly abstracting from that. So I mean, one of the, okay, so that's totally true. So if you're sort of a very high cost miner, you're a small operation with low, because there are, there are economies to scale in mining. You know, one of the things that I learned when I attempted to do this Ethereum mining was that it just wasn't profitable because these things don't just run themselves. You know, you have so much of a flicker in your power and the thing gets disconnected and you have to reestablish the link and all this sort of stuff. And if you're just running one small rig, it just isn't worth it.
That's why you stopped.
Yeah. Well, months. Yeah, exactly. And so, but there are huge economies of scale in that type of oversight. And so, the question is correct in the sense that if you are a very low cost miner or high cost miner, so to speak, you could sell your equipment to a high cost miner. We don't account for that.
So my feeling when I talk to miners, professional miners, is that they actually get the best hardware even before they're on the market. They run them and then they sell them to low efficiency miners. So it's more like they first get the top stuff, and when they are done with it, they sell it down and they buy new machine.
No, that's absolutely true.
So so Andreas has a question. So I will unmute him. Let's see. Andreas.
Hi, Andreas.
Great.
Hey, Rod. So this is great. I really like this. I've been thinking about this too in some sense because it seems, I mean, you know, at the end of the day, what you're saying is you have skin in the game and you have it when you have fixed cost of mining, then that provides some additional security, if I understand it correctly. And in some sense, this is it's almost similar to proof of stake in some way, right? Because there also you have skin in the game and you have an incentive not to shoot yourself in the foot by double spending. But I have another question here, which is, so the way I understand it, your double spending always applies to the internal cryptocurrency. Whereas if we think of what happens on Ethereum these days and on many other blockchain networks is that they're building DeFi applications, they're building additional tokens that are not priced according to the internal currency. So can you speak to some extent whether or not your model also has something to say about double spending attacks on other assets that may be stored on a blockchain?
So I guess I don't fully understand the question, Andreas. So do you mean that I have do you mean if I'm going to use the mining power that I've currently dedicated to mining, say, coin A, maybe exclusively, and whether or not I have some incentive to apply that mining power to double spending on cryptocurrency B? Is that the idea?
Not entirely. So if you think of, say, Ethereum, in Ethereum you can create a token. You know, think of it as a stable coin. So I could try to steal or double spend a stable coin, which runs on Ethereum. So I would do that by using my Ethereum mining power, but the double spending is regards to something that is not priced in ETH, but it's priced in dollars.
Yeah, so I mean, I guess the answer there would simply be that the channel through which double spending becomes costly in our model is that you are lowering your own earning stream. So that earning stream being priced in the native cryptocurrency of the chain. So if there's a way that you can utilize that mining power to attack something that you don't own, then that's more profitable. In that case, the only thing that you might lose is you might face, you know, some delay costs associated with not earning rewards during the time that you've allocated that mining power to the attack, or maybe you don't ever get those rewards. But otherwise, as long, you know, it really just the loss from the double spending attack comes from the devaluation of the currency you're attacking. So if that loss doesn't occur, then that component doesn't apply.
If I may step in there, Rod, just to add a little bit,
Sure.
To provide a little bit more color. So in terms of the model, if you think about the parameter that's actually looking at a drop in the exchange rate, whenever that one parameter occurs in the model, it's also in front of actually the number of mining rewards that you get. So you could equally think about this parameter L as a reduction in, say, the number of coins that you get every round, or transaction fees. So in that sense, if for example, if there would be a double spending attack on Ethereum, but it would be on a particular smart contract, say, for example, a stock in a particular firm, even if the exchange rate would not drop, or even if the price of that particular contract of that stock would not drop, then still people might just start to use Ethereum less, because these type of double spending attacks can occur. So if that would lead to fewer transactions, less use of Ethereum to make, say, transactions in tokenized stocks or other smart contracts, in that sense, it could still harm the miners, and therefore there still would be an impact of fixed effects. But basically, this requires just interpreting this parameter L as an overall drop in the mining rewards, like in the dollar value of the mining rewards, rather than just a drop in the exchange rate.
Thank you. Very interesting.
So I don't see any more questions. So maybe I have one quick question related to an attack that was performed, I think, at the beginning, early on in Bitcoin Cash Live, sorry, where a miner from Bitcoin will migrate to Bitcoin Cash and mine a lot of blocks and then go back on Bitcoin, because the hardware was common across both protocol. So do you have something to say about that? I think it fits your story pretty well.
No, absolutely. That is our story. I mean, currencies like that are extremely vulnerable.
It happened historically. It was more sophisticated than that. They manipulated the difficulty algorithm in Bitcoin Cash, and then they will come and produce hundreds of blocks in a few hours, something like that.
No, that's, yeah, and that's, I mean, all I can say is that that's just completely consistent with our story. You know, and as I said, so it's like you can attack the small currency, but you can't go the other way around, right? Because you can't use that small amount of mining power that's allocated in the altcoin and use that to attack Bitcoin, because Bitcoin is so much larger. So that's wholly consistent with our story. Yeah.
Thanks for pointing that out, Julian. That's actually a great story to add.
Actually, I missed a question, so sorry. Will has a question. What period does the data sample cover? Are we accounting for the introduction of ASIC around 2013? And it is probably different. It occurred probably at a different date for other cryptocurrencies, no?
Yeah. So the data periods are roughly 2014 to early 2019. Meeting, as I said, we had this criteria for collecting the data. This is all in the paper, by the way. There's an appendix that explains exactly what the data is. So, well, you can take a look at that. But as I mentioned earlier, it's really tricky business, because as we're saying, we're recognizing that some coins use ASICs and some don't. But essentially, eventually they all do. I mean, the ones that start off that are intended to be ASIC resistant, it seems that eventually someone develops something that is a form of ASIC chip for that currency. But what really matters for our story, and I'm glad you brought this up, is that what really matters is whether or not it's a specialized chip. That is, whether or not the chip is sort of somewhat unique to that currency, and so therefore has a low alternative use value. So an ASIC chip that's used for Bitcoin really has no use for anything else. Maybe there are these very, very small coins you can use it for, but you know, something like a graphics card, or even chips that are developed that are somewhat specialized for using these other currencies, if that chip can be used across multiple currencies, that's where it becomes problematic, because then you get this ability to substitute, even if it's still technically an ASIC chip. What matters is whether or not it can be substituted across multiple currencies. That's really the key issue. So
maybe, I mean, I have other questions, so I guess we can keep going if that's fine with you, Rod, and people can leave. It's one of there's very few advantages of webinar, but it's one of them. You can leave the room without being noticed. So yes, we are running over time, but since questions are coming in now, I think it's fair to take them. So Arya Klaglesmunt, so I'm sorry for the pronunciation, asked whether she didn't really catch why we would expect the price path to be with respect to the previous peak. So why you use the previous peak in the regression, and why do you have dependency with respect to the previous peak?
Sure, happy to answer that. So the idea is that, so think in terms of the sort of standard fixed cost, variable cost type argument. So the idea is that you're in this long run equilibrium where people have entered up to the point where the revenue, the present value of the earnings equals the investment costs. So everybody's happy. The price, the exchange rate doesn't change, and we're all just happily mining away. And then the price drops a little bit. Okay, say it drops from 100 to 80. Okay, it drops from 100 to 80, but we keep mining because it's Bitcoin, say, and we have nothing else we can do with these units, and we're still covering our variable costs, so we keep mining. And now suppose the price rises from 80 to 90. Okay, well, nothing really changes. We were mining the whole time. We mined as it dropped to 80. We didn't back off, and it goes up to 90. Nothing changes. Mining is still not profitable. So no new units get added when the price rises from 80 to 90. But now suppose the price rises all the way up past 100 up to say 110. Well, now all of a sudden it's profitable. All of the chips that we were using already are now making positive profits. And so it's profitable for new entrants to come in. Of course, those new entrants drive the price down, drive the value of Bitcoin mining down, not the price, but they drive, there's more miners, so their share falls. So when we go from that price of 100 to 110, then we get new entrants. So we only expect to see a positive increase in mining when the mining level rises, or when the exchange rate rises above the previous peak.
And just to add that, like what we're kind of testing here is like we're testing whether it's only variable cost or whether there's also other costs involved, fixed costs. So in our variable cost story, like the mining power should always be proportional to the exchange rate. At any point of time, there should never be any pot dependence. So you can show pot dependence in multiple ways, and one way is to show that the historical peak is relevant. You could do it in other ways as well. But the fact is, we find statistically significant pot dependence, so there are fixed costs in play.
Okay, so yeah, I think we have really run out of time now. So if you don't have anything to add, Rod or Martin, I will thank you for this great presentation and thank all of you for attending this talk. And repeat what I said at the beginning. So we are meeting twice a month now, and the next meeting is on Thursday, the 17th of September. And there will be free talks on cryptocurrencies.
Thank you. Thanks a lot for all the questions.
Thank you.